Thank you very much indeed. To the markets, to be honest, there's not much action today. We are seeing light volume already here in Europe. European equities down by around 0.5%, a little shy of that. Looks like the US is going to open fairly flat. We don't have really much movement when it comes to the bond market as well. As you can see, a 4 basis point move. So a little sell-off when it comes to the bond market. We're trading 192. We'll trade pretty similar sort of stories here in Europe. We're talking about the Fed in just a moment. And euro dollar above 111, in fact, nearly at 112, 111.95 for the single currency versus the US dollar. So the Federal Reserve projections show no interest rate changes next year, but the annual rotation amongst voters could still influence policy as incoming members include a number of outspoken doves. 2 hawks, remember, are departing. Minneapolis Fed Chief Neil Kashkari, who has called vocally for rate cuts during 2019, is, of course, the clear dove amongst the 4 new voters. He joins alongside Kaplan from Dallas, Philadelphia's Patrick Harker, Loretta Mester is also joining and voting from Cleveland. Edward Stringham, the American Institute President of Economic Research, joins us now out of New York. Do you think the Fed does nothing in 2020? Will it sit on its hands?
It's kind of confusing. I was hoping that rates were going to be continuing to go up to their historically normal levels a year ago. And we saw over the last year the 3 main rate cuts for the federal funds rate. Current Federal Reserve officials indicate they're going to be sticking with the current rates for 2020. On the other hand, if you do look at implied probabilities of certain markets, it does indicate a potential new rate cut in 2020. So I think most people are expecting rates to either stay the same or perhaps even see a further rate cut, which I do actually still think the whole thing is a little bit odd.
Yeah, the market's got that rate cut priced very much towards the back end of 2020. Given what is happening politically, it would be interesting to see if the Fed actually delivered that cut. But nevertheless, I take your point. The market's basically signaling that we are going to be sitting on our hands throughout most of next year. Why do you think it's odd, given the fact that inflation remains so difficult to move upwards?
Well, you know, we've got a series of record highs in terms of, the stock market's going really well. We've got record low unemployment rate. We have vast increases in labor participation rate. So all economic variables are going well. And then at the same time, they're now engaging in what historically they would have been calling expansionary monetary policy. Now they're calling it accommodative monetary policy. And I think it's interesting that as they do that, as they push interest rates closer to zero, it's in the long run going to eliminate, even from their own perspective, their ability to engage in further accommodative monetary policy, expansionary monetary policy, if they need it. So I think that it was a little bit surprising to a lot of economists. I know that when they were raising or letting rates raise at the end of last year, and then all of a sudden reversing course, I think it's going to eliminate their ability to be even adjusting things.
There is this argument, and you hear it increasingly from Jay Powell, but you also hear it from other members of the FOMC. The Fed's objective now is to try and keep the cycle going for longer. And the reason they want to do that is that they want the outer extremes of the labor market, those people that normally struggle to find work, to be able to benefit from this economic upswing, i.e. that everybody in society should benefit. There is this feeling that maybe the Fed cuts off expansions too early, and as a result of which those right at the bottom of the socioeconomic scale don't get to benefit. I'm hearing this more and more from Jay Powell, and I say from others. What do you make of that argument?
Well, it is true that wages are up at all levels, including high-income people. Wages are up 3%. But among lower 25%, wages are up even more. The latest statistics were up 4%. So it is true in this case that a rising tide has been lifting all boats. That's translated into increases in employment rates, and then also with wage rates. In terms of the Federal Reserve specifically being able to target individuals and target different income levels, I think it's way too blunt of a tool that they don't really have that precision. So I don't really buy into the argument that the Federal Reserve can be targeting different income levels.
Edward, we're going to carry on the conversation. Stay with us. Edward Stringham of the American Institute. Up next, a senior diplomat is urging the U.S. to honor the one China policy. This comes as Beijing's ambassador to the United States says China will honor its commitments as part of the Phase 1 deal. We'll talk about trade. We'll talk about Hong Kong. That's next. This is Bloomberg. Good morning. Nearly 10 minutes past the hour. I'm Guy Johnson, in for Tom Keane and Francine Lacroix. They're both off today. A senior Chinese diplomat has suggested the U.S. should honour its commitments to the one China policy as part of the Phase 1 trade deal. China's ambassador to the United States has added his nation will, quote, always implement what's been promised. The commitments come as Beijing and Washington are, of course, working on the final details of that interim Phase 1 trade deal. Joining us now here in London, Conor Hack, ED&F man, head of research, which provides commodity analysis, if I can get that out, for the firm's physical sugar, coffee, new grains traders, and its brokerage arm. And still with us in New York is Edward Stringham of the American Institute. Good morning.
Good morning.
How optimistic are you about 2020? How optimistic are you about this trade deal that's being done, this skinny deal, actually delivering some economic uplift which is going to benefit the commodity sector?
I would say cautiously optimistic. And the reason for that is if you look at the track record of the past 18 months, we've had one step forward, two steps back every time we've sort of come to an agreement. And the markets jump every time there's some kind of agreement or talk of an agreement or tweet, if you like. But then it peters out and nothing comes of it. So this Phase 1 trade deal sounds good on paper. We haven't had any agreement.
We're kind of light on detail at the moment, aren't we?
Exactly. And this is my worry. It's that it's not a trade agreement. It's a partial one. All of that has to be implemented. And then there's the whole issue about intellectual property. You know, what's going to be bought in this $40 billion additional US dollars worth of Chinese goods that they're going to buy. This is all to be played for, and it's really might not be as easy as people are thinking it's going to be.
Edward, let's turn to you in New York. How optimistic are you about this trade deal? The market's got very excited. We've rallied into year-end. Risk assets are looking pretty good. Yet, as Conor says, we still don't have any details on what exactly this skinny deal is. We don't even know how skinny it is.
Exactly. So I think this whole trade war started by the U.S. government has been tremendously disruptive towards markets. Tariffs are basically taxes on corporations, American corporations who are buying inputs from abroad, also taxes on American consumers as well. And that's disrupting global supply chains all over the world. Now, the positive news is the government is easing off on that and saying, OK, we're not going to continue ramping up tariffs. We're going to be easing off on these things. So from that perspective, the fact that they're not going to be continuing to pursue the trade war as much is tremendous for markets. People think, OK, great. Now we can actually focus on doing business again. The weird part is, why did we even get into it? It's not clear to me what the final outcomes are going to be. So there's still a lot of uncertainty by this whole mess.
And Conor, one of the things as you said, we've got to get onto the kind of the sticky subjects, the difficult subjects. And the president has already indicated, the president of the United States, that he wants to sort of get going with Phase 2. My question is, will tariffs continue to be the kind of the stick of choice when he does so? Because if so, we could find ourselves back in a situation where tariffs are being reapplied and the market's almost back to square one.
Well, Trump has said himself he loves tariffs. He thinks tariffs work. So I think it will be his weapon of choice. To what degree he'll be able to be successful on that, it's debatable. They have hurt both the Chinese economy and the U.S. economy. And as he gets closer towards re-election phase from the November elections, I think he's going to want to make sure that the U.S. economy receives a boost. To that end, he might start using that to leverage himself. So I think he might try and get to some sort of deal just to get a U.S. economic domestic boost. That'll happen. But on the other hand, if China has any sort of doubt that Trump might not get re-elected, then why would they sign something if they don't know who the next president's going to be? It's not in their interest if they know that actually could be the Democrats.
So you don't even think this is a done deal yet?
I personally think phase one will happen, as in the avoidance of the second tariffs. The current tariffs are still here, though, and that's still hurting the economies. So that, I don't think, is going to disappear overnight. That's going to take some time, and that'll be still to be played for. If Democrats get in, you might get a China hawk. If Trump stays in, what's Trump 2 going to be like? Is he going to continue to be a tariff fan, or is he going to start looking more about the intellectual property rights, the economic and financial liberalization? That's all stuff that the Congress as a whole are quite interested in.
Edward, what happens to the U.S. industrial sector over the next 12 months? The consumer looks fairly okay, and the latest set of tariffs aren't going on. They were likely to affect the consumer the most. But it's been the industrial sector. The ISM data's been weak. The latest durable goods number wasn't exactly great. People are not investing in equipment in U.S. factories. We're seeing the similar thing over in China. What will it take to get that sector back online, that sector willing to invest? Do you think this trade deal is going to be enough?
I think anytime they let off these tariffs, these interferences with business, interferences with global supply chain management, that's going to be tremendous. We've got a lot of things that are going extremely well in the economy. The lowering of corporate tax rates from a couple years ago, that's good for corporations. Corporations are investing more. We see American stock markets performing extremely well. We also see the deregulation of the economy also leading to a lot of increase in economic activity throughout the United States, and also, I would say, positive effects in other countries as well. Now, obviously, we don't know what the future is going to have, and we could have a less successful year next year. But by all measures, things are going very well in the American economy right now.
We'll come back to that subject. Edward Stringham of the American Institute for Economic Research and Connor Hack of ED&F Man Research staying with us. And Tesla's China milestone. We're going to talk about that next. The electric car maker delivers its first car built in China. It's a key moment in Elon Musk's push into the world's largest car market. Tesla trading 430 going into today's session. This is Bloomberg.
This is Bloomberg Surveillance. I'm Karina Mitchell. Let's get the Bloomberg Business Flash. It is a milestone for Tesla. Elon Musk's company has delivered its first cars built in China. Tesla handed over the first 15 Model 3 sedans assembled at its new multi-billion-dollar factory in Shanghai. The owners are company employees. Tesla wants to ramp up sales in China, the world's largest electric vehicle market. In Hong Kong, 6 months of violent protests have rocked the economy. Financial Secretary Paul Chan warns that GDP is set to contract in the fourth quarter. Hong Kong's retail revenue has dropped by about a quarter. Meanwhile, the number of mainland Chinese visitors has plunged by almost half. And the French-Italian eyewear giant EssilorLuxottica says it was a target of a $213 million fraud at a factory in Thailand. The company is trying to recover the lost funds. EssilorLuxottica is the owner of Ray-Ban and Oakley sunglasses. It diffused an internal power struggle earlier this year. And that is the Bloomberg Business Flash. Guy?
Thank you very much indeed. Let's talk commodities. Oil trading higher. Cotton is surging after Brazil's exports soared to a record level. And China has been opting for supplies from Brazil amid the trade conflict with the United States. Meanwhile, the Bloomberg Commodity Spot Index has hit its highest level since November 2018 as trade tensions start to ebb a little bit and that risk-on mood Sweeps across markets. The dollar also easing back helps. Still with us, Edward Stringham of the American Institute for Economic Research, Connor Hack of ED&F Man Research. Connor, let's talk about what you see next year. This is your bailiwick. Metals kind of, I guess, need the trade deal to get going. Oil, well, there's a lot of it about. Where am I going to get some outperformance in 2020?
Okay, so within the complex, I would put my money in the agricultural sector. The sector as a whole has been underperforming for the last 5 to 6 years, essentially on oversupply, grains, harvests, sugar, coffee, everything, abundance of sugar, coffee, oil seeds, everything, all that's around. What didn't help clearly was the trade war, Chinese-US trade war, where the two largest exporters and importers have a clash. They're not buying from each other, and that's led to a real standstill. So this phase one trade deal, that provides a lot of short-term optimism. And clearly the markets, as you've seen in the last 2 months, have rallied quite a bit on the prospects of a potential lifting of tariffs. Maybe. I think they might have got ahead of themselves a little bit because, as you said, there's not anything been agreed fundamentally. So if this were to patter out, then I think the market could start. Markets have basically priced it in. If this were to now become not a non-issue, then I think the markets would have to dial back down some of that euphoria and start coming back. I would say, trade war issues aside, let's assume we have a phase one trade deal. I think the ones to benefit would definitely be oilseeds and corn in the agricultural commodity space, because these are the markets where US has a big, sitting on large carryover stocks. They would potentially be able to offload some of that to China once a deal is there. So that helps certainly the markets. The Chicago futures would all rally in the prospect of that. In the soft commodity space, sugar and coffee and cocoa and palm oil, these are actually fundamentally well supported because the markets are actually going to move into deficits. So there's actually going to be a supply shortfall. So I think fundamentals alone, and irrespective of Chinese trade war deal, I think that could potentially have some good support on the back of just fundamentals. Then you've got the hard commodities, if you like. So metals, I would say supplies aren't terrible, pretty well supplied. If you look at the ones that performed really well in this last 2019, it was iron ore and nickel. That was all entirely on supply side issues because demand's just sort of pretty average. So much depends on China's economy. And if a trade war resolution happens, China's economy gets kick-started, trade resumes, import demand resumes in China, that'll definitely help the base metals and industrial metals.
You mentioned the dollar in there. Edward, let's get your take on the dollar. Where do you see the dollar going? Your view is that the Fed should probably take a slightly more hawkish line at the moment. Do you anticipate that we're going to see a reasonably strong dollar in 2020?
Well, we always have to be guessing, and as we know, there's so many variables, and we have to be figuring out what the Federal Reserve is doing. I was interested in the fact that their balance sheet was decreasing over the last couple of years. And now, unfortunately, at least from my perspective, we see a reversal of this. They're not calling it quantitative easing at this point, but they are basically, printing, doing the equivalent of printing more dollars. And what is that going to do to the value of the dollar? Well, if in the past 10 years, they've sterilized a lot of the increases in the money supply, so it actually hasn't been circulating in the economy and causing the inflation that many people would have predicted. But, sometimes this could show up. Inflation has long and variable lags. Monetary policy has long and variable lags. And so something that they might have implemented 5 years ago might show up a year later, even 5 years later. And the fact that they're printing more money right now could see a weakening of the dollar.
Connor's going to leave us now. Thank you very much indeed for coming in to see us this morning. Connor Hack, ED&F Man, Head of Research. Edward's going to stick around. Edward Stringham. We're going to be talking about the president. We're going to be talking about impeachment. This is Bloomberg. Good morning. I'm Guy Johnson. Tom Keane, Francine Lacroix off today. Let's get some first word news, though. Karina Mitchell joins us now from New York.
Guy, President Trump is facing criticism for outing the alleged whistleblower whose complaint led to his impeachment. A retweet to the president's 68 million Twitter followers identified a person it says is the whistleblower. Critics say that's against the law, and Republican Senator John Kennedy suggests the president tweet a little bit less. In New York, a suspect is being held in a multiple stabbing during Hanukkah celebrations. Officials say a man burst into the home of a Hasidic rabbi Saturday night and wounded 5 people with a large knife. New York Governor Andrew Cuomo calls it an act of domestic terrorism. And in Southeast Australia, wildfires have forced thousands of people to flee a popular tourist spot. The fires have been fueled by a heat wave and strong winds. It's the latest development in a crisis that's gripped Australia since fires broke out last month. A global news 24 hours a day, on air and at Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Guy.
Karina, thank you very much indeed. Let's get back to the story that Karina was just bringing us about the president's tweet and the whistleblower, and whether or not this actually changes anything vis-a-vis what's happening with impeachment and as we track into 2020, the election. Pippa Malmgren, UK Department of International Trade advisor, DRPM Group founder and former presidential advisor to President George W. Bush, joining us now on set. She's also the author of The Leadership Lab. We're also back with Edward Stringham of the American Institute. Pippa, let me start with you. The big picture here is, as an investor, can I continue to largely ignore impeachment as a risk to my portfolio? Because I'm pretty much still of the view that while there is an impeachment process in the House, the Senate is largely going to cancel it out.
That's correct. But also the question is, even if it were to occur, what would it change? I mean, we're coming into an American election anyway, so we have uncertainty anyway about who the next president's going to be, although right now it's looking a little likely that it may still be the same president. In which case, the bottom line is, as long as even if he is impeached, there still is a conviction process that has to occur. That's a different thing. You can be impeached and not convicted.
Absolutely.
So, I don't know. I think markets are... The more important thing is what happens in the longer run. And is there really a probability of a president arriving who's going to profoundly change the economic landscape of the country? And right now, that doesn't look as likely.
Edward, what's your take on this? Because at the moment, the financial markets are ignoring US politics. It is going to get interesting in 2020. It is going to be something that the market has to pay attention to. We're not there yet. We're kind of watching the impeachment story, but it does seem as if we have a House that's willing to impeach, but a Senate that's not willing to convict. Where do you sit on this? What kind of effect do you think this has, both from a market perspective and economically, if anything at all?
Not only are markets ignoring American politics, Americans are ignoring American politics. It's increasingly clear that this is just a big political stunt. And the likelihood, the probability that the Senate is actually going to convict on any charges are just extremely low. If you look at election betting odds, the probabilities of various things, including the president serving his full term, it's well over 90% at this point, the highest in his presidency. So I think it's just a big political charade. People are all up in arms about it. But as a practical matter, I think most market participants are saying it's not going to happen. And why even pay attention to it?
OK, let's come at this from a different perspective then and try and think about ways in which US politics could affect the things that markets care about. The trade deal, the Fed, these kinds of issues.
Oh, sure. That
Pippa,
can definitely.
Yeah, sorry, Ed, carry on then.
Yeah, so we've got the potential for impeachment, and people are basically ignoring that and saying it's not going to happen. On the other hand, there's a lot that politics does affect markets on, and that is things like taxes, things like deregulation. And if a new politician were to come into place to fundamentally change society, tax the rich, tax billionaires, tax corporations, that actually would be tremendously disruptive, I think, towards stock markets, towards Wall Street specifically, But here, too, I think that a lot of Americans are not having an appetite for some of these more extreme policies, and a lot of these people are actually falling in the election betting odds. So I think people tend to be actually happy with business as usual, with the economy as usual, and I actually don't really see too much of this crazy potential disruption that a lot of people are talking about, calling for.
Okay, Pippa, let's get your assessment on this. How does U.S. politics affect the Fed this year? Does the Fed sit on the sidelines because as the political narrative starts to gather momentum towards November, then it becomes harder and harder to do anything with rates? Is the president, let's assume that this phase one trade deal gets done, is that enough to give the president the kind of economic boost he is looking for as we head towards November as well?
Oh, yeah, a trade deal would be great for the president as he goes into November, and I think that's what he's swinging for. Oh, yeah, I think it's wonderful. Oh, look, the markets take the slightest hint of a deal and they throw the stock market prices up in the air. So, yeah, he doesn't even have to have a conclusive arrangement. It just has to be something better than what we had before. As for the Fed, look, in a sense, the Fed and the president are already aligned, right? The Fed doesn't want to be, they've already said they're going to go very gently. As our other guest said, they're already effectively printing money. That's what the president wants too. We fundamentally have policymakers in the United States who are willing to take more risks with inflation. And what's really interesting is I'm talking to the biggest investors in the world, and they're all saying, you know what, we have a little inflation, and that means I cannot be in debt. I don't want to get paid negative interest rates, and that means I've got to put my money to work. They're all looking for equities, infrastructure, hard assets, real estate. In other words, we're at the beginning of a buying period, and it's because policymakers are in this, let's take some risk with inflation mode.
If you take a look at the 5-year forwards, the market's not pricing in a great deal of inflation.
No, it doesn't have to be a great deal. For a pension fund or for a sovereign wealth fund, the move we've already had from 1% inflation to, say, 2.5% is massive. This is a radical change in the allocation of your assets. You add another 0.5% to that, this is an unbelievable shift in what they used to own versus what they're going to own now.
So simply the savings glut is going to drive equities higher?
Look, we put $20 trillion into the world economy when the global financial crisis happened, and guess what? It's still there.
Yep.
And all that money that's been sitting on sidelines and saying, I don't want to buy equities because they're too high already, they're going, you know what? I got to be in somewhere. What's also interesting is many of the big investment banks are reporting that 100% of their clients are prepared for a recession, which means people are not prepared for a melt up, which is what we have been experiencing.
Stick around. Edward Stringham's going to stick around. He's from the American Institute. Pippa Malmgren of DRPM. She's going to stick around. Coming up, the year-end melt-up. Pippa was just mentioning it. We're going to bring you the single best charts with the year-end rally, sending some technical sell signals. We'll talk to Pippa about that. There's the chart. This is Bloomberg.
You've got all the ingredients here for a classic melt-up.
Melt-up scenario in the first half of the year, catalyzed by the UK election results, the acceleration of data improvements in the US-China tariffs.
Look at the liquidity.
Well, that's a pretty good cocktail.
There's still risks out there.
If we don't start to see an earnings turnaround,
can these stocks actually deliver the earnings growth that's being expected of them?
You could easily have some election year disruptions.
The election's going to become front and center.
Investor attention move away from some of the political concerns.
Right now, it doesn't look like there's anything in left field to come at us.
Investor sentiment, they're bullish.
Can't be too bullish or bearish at this point.
We're going to see this FOMO environment become an issue.
It's hard not to see room for a potential overshoot,
where we start fearing the fear of missing out.
FOMO, melt-up. You're going to hear a lot about that over the next few weeks. The question is the market too optimistic right now? Pippa doesn't think so. Let's get back to Pippa Malmgren. Pippa, the market is not positioned for a melt-up.
Exactly, which kind of is a good starting point. And I think it's funny, how long has this been going on? I mean, I've been coming to see you, the last 6 years it's been like this, every year. Yep. The market's waiting for this catastrophe that doesn't happen. And there are many reasons.
That happened this time last year.
But look how fast we recovered from that.
We bounced back, the Fed turned around.
Exactly. So this is to the point that the resilience level is so much higher than people realize. But I also think we're underestimating the massive impact of innovation and technology. And I'm in that space. As a manufacturer of autonomous vehicles and drones, every company I work with, I watch their margins increase. Yep. They literally improve their efficiencies on such a scale.
That's not a very big sector, though. That's not a big enough sector to get the market turned around and moving, though, is it? It's a long burn sort of story.
Let's put it this way. Barclays says it's a tenfold increase in 5 years from $4 billion to $40 billion. Now, that's maybe not big enough to move the whole equity market, but that's an unbelievable increase for one little part of technology, not all of it. And let's face it, what it affects is every sector, right? I'm working with mining, public safety, infrastructure, oil and gas. All of these sectors are touched by what's happening in automation and autonomous vehicles, as just one small example. But the innovation happening across all of the sciences is extraordinary, to the point that people can't keep up. And I love this word, atomania. Atomania means this overwhelming feeling of that you can't keep up with how fast things are moving. When you're in that environment, how can you be a pessimist?
Okay, at the moment, if you look at the American capex numbers, they're not. American companies are not spending. Edward, let's come back to this conversation. What will it take to get U.S. companies, industrial companies, spending in 2020?
Well, I think economic fundamentals are strong. We see small improvements every single day, every single year, actually. And there are always going to be fluctuations, of course, obviously. But at the bottom, capitalism is moving forward. People are confident. The fact that there's an easing away from trade tensions, that gives more stability to American corporations. They can actually start investing in the future. I liked the tax decreases a couple of years ago, and I was actually thinking at the time, I wish they were larger. And I think the results are in that letting corporations keep their money leads to more investment in the American economy. And I would say if it was good then, we should do it again. Let's have even more tax cuts, lowering of capital gains to encourage more investment in the United States, in markets around the world.
But the uncertainty at the moment about what's happening, trade is the big feature of this, is meaning that American companies, it's happening here in Europe, believe you me, it's happening in Germany, are not investing money.
Oh, that's right. I mean, we don't know still what the final outcomes of these trade deals are going to be. I think the whole thing has been tremendously disruptive for supply chain management. Certain industries have just gotten decimated. American soybean industry, for example, can't sell their products to China. A lot of individual American brands that were very popular in China are no longer popular because there's this whole kind of this tension where the Chinese people are like, why? We're just trying to help American consumers, and now the American government is all angry at us, and we see a decrease in the demand for certain American products. So there is this tremendous amount of disruption, shifting supply chains from China to Vietnam, and then now rules about that. So there's still a lot of uncertainty, but the more that the government can get out of messing with American business, with global business, I think the better off the economy will be.
Pippa, why is that going to happen? People are talking. One of the phrases that comes out of 2019 for me is the splinter net. We're talking about China and the United States being on very different pages.
Absolutely. But in a sense, we're watching the relocalization of production. And I don't think it is just Vietnam. Relocalization of production is very much in the United States as well. It's in Britain in addition. And so actually you have production happening in China and you have production now happening locally everywhere else.
Is that production, when it comes back, good? Because what I hear from talking to companies is if they're reshoring production, they automate it. They don't generate jobs out of it, they automate it.
They do automate it more, but China's automating it even faster, so it's not like that it's different in China. The other thing, too, keep in mind is that, again, as somebody who's in manufacturing, you don't have to move goods across borders the way you used to. You can build a drone on the other side of the world simply by sending an email with the CAD design, right? We're in a world of 3D printing and laser sintering. And I don't think that all the investors have really clocked that their old measures of what's going on in the world don't apply. Like, for example, we look at the shipping indices. Yeah, but I don't have to ship anything.
Yeah.
I have to email something. I literally send instructions. That's a totally different world where many of these disruptions that you're describing simply become irrelevant. They just aren't that important anymore.
Somebody was telling me the biggest threat to the car sector is not electrification, it's VR.
I completely agree.
You don't have to go anywhere.
Yeah.
We're going to leave that conversation there. We'll come back with more exciting conversations in just a moment. Edward, thank you so much for joining us today. We really appreciate it. Edward Stringham, the American Institute for Economic Research president. Pippa's going to stay with